Spokane's retail vacancy held at 5.3% in Q2. But behind that number is a fascinating story of a market digesting massive idiosyncratic shocks, like a 146,000 square foot Burlington store converting into an absolute ocean of self-storage rather than, a systemic collapse in demand.
It's the classic trap of taking a headline statistic at face value.
Right.
You see a jump in vacancy, you immediately assume people just stop shopping or, businesses are failing across the board. But when you walk the actual brick and mortar landscape, the truth on the ground is way weirder.
Much more specific.
Yeah, exactly.
Well, welcome to this deep dive into the Q2 2026 market report for the Spokane retail market. If you're actively managing a commercial portfolio right now, or if you're hunting for that next strategic acquisition, or, if you're simply trying to figure out where this local economy is steering us, you are in exactly the right place.
Absolutely.
And just so you know, every single figure we are unpacking today comes straight from the Q2 2026 market report, which is powered by Coast Guard data.
And our promise to you is pretty fickle. In under 20 minutes, we're going to strip away the noise. We'll hand you the absolute most critical insights you need to understand the mechanics of this specific market right now.
No fluff.
Right, no fluff. Just the signals that actually dictate where the capital is moving.
Yeah, and before we really get rolling, just a quick heads up. If you want a custom market breakdown tailored to your exact investment situation, or, if you have questions as we go, you should reach out to Eric Peterson.
Highly recommend it.
Yeah, he is a broker at ACTIV8, ACTIV8 Real Estate. And you can call him directly at 509-903-9077. Okay, so I say we unpack this with a quick quarter in a minute. Let's just set the baseline with the headline numbers. First up, demand and vacancy.
Let's do it.
So, Spokane retail vacancy is currently sitting at 5.3%. For context, that is roughly 90 basis points or 0.9% above the national average of 4.4%.
Yeah, and second is supply. Construction is basically on ice right now. We're looking at only 49,000 square feet currently underway. And almost half of that is already pre-leased. So to put that supply number into perspective, the 10-year average for this market is 130,000 square feet.
That's a huge drop.
It is. The pipeline isn't just slowing down, it has practically ground to a complete halt.
Right, a total standstill.
Yeah.
Okay, third headline is pricing. Rent growth is pretty sluggish, crawling at like 1.0% year over year, which is definitely lagging behind the national pace. That's sitting comfortably around 1.5% to 1.7%. And finally, the capital markets. Trailing 12-month sales volume hit $107.3 million, with market cap rates hovering right around 7.4%.
So if you remember only one overarching theme from this quarter's data, let it be this. Spokane retail isn't collapsing.
Yeah.
It's just a soft, stabilizing market. It is essentially waiting for the dust to finally settle on the big national bankruptcies of 2025 and, for buyers and sellers to stop glaring at each other and actually agree on pricing.
Which is always the hardest part, right? So to understand why a developer might hesitate to break ground on a new center, or why a retailer might stall on signing a lease, we can't just look at the buildings.
Right.
We have to look at the people walking through the doors, the consumer. And according to the data, Spokane is entering the back half of 2026 in what the report actually describes as an economic malaise.
Yeah, it's a heavy word, malaise, but it's remarkably accurate here. Job growth in the region is essentially flat right now. It's hovering between 0 and 0.5%.
Barely moving.
Barely. We've transitioned completely out of that high turnover, great resignation era into what economists are now calling job hugging.
Job hugging. I love that term. I just picture someone literally wrapping their arms around their office chair.
That's a great visual, yeah.
It makes total sense, though. You look at inflation over the past few years, you look at the high interest rates, and if you have a stable paycheck, you hold on to it for dear life.
Exactly.
You aren't taking risks. You aren't jumping ship to a startup.
Precisely. The leverage has shifted firmly back to employers. Workers are, they're highly risk-averse right now, and compounding this stagnation is a wave of elevated retirements.
Oh, right.
Yeah, older workers are permanently exiting the workforce, which thins out the labor pool without necessarily creating that dynamic upward mobility or wage spikes for the younger workers.
Okay, let's unpack this. So the local economy basically feels like it's on a treadmill, moving, sweating, but not really going anywhere fast.
Right.
But let's look at what's actually powering that treadmill. Healthcare is massive here. It accounts for, 1 in 5 jobs in the region?
Roughly.
That's about 61,000 total jobs in the education and health services sector alone.
It is the undisputed engine of the Spokane economy. And having a medical hub, it provides this incredible baseline stability. Doctors, nurses, hospital administrators, these are generally reliable, well-paying jobs that insulate a city from wild economic swings.
Yeah.
However, reliance on one massive sector is always a double-edged sword.
Right, because the report flags those proposed Medicaid cuts on the horizon as a serious vulnerability.
Yes. If those cuts actually materialize, it directly impacts hospital revenues. And when hospitals lose revenue,
They cut costs.
exactly, they freeze hiring, they delay expansions, or they cut administrative staff. That contraction then ripples straight into the broader local economy. I mean, a nurse whose hours get cut is a consumer who stops eating out at local restaurants. It's a major risk factor to monitor in Q3.
Okay, but it's not a purely bleak picture, is it? People are still moving here.
Oh, definitely.
The population is growing steadily at about 1% a year. The combined Spokane, and Coeur d'Alene area, let's just call it CDA from here on out, is closing in on 800,000 people.
Yeah, it's booming.
And median household income is sitting around $86,900.
Which is a genuinely fascinating data point, honestly. A decade ago, Spokane lagged significantly behind the national average for household income.
Wow, really?
Yeah. But today, that $86,900 figure is actually slightly above the U.S. average. The region has fundamentally leveled up its earning power.
Okay, but here's where it gets really interesting to me.
Yeah.
You have higher incomes, you have a growing population, but taxable retail sales are only expanding by a meager 1% annually.
Right.
So the community has the money, but they are holding on to it. How does this job-hugging psychology directly translate to how consumers are spending at local retail centers?
It forces a massive pivot to essentials. When consumer confidence drops, discretionary spending, the boutique clothing, the high-end electronics, those experimental fitness studios.
Nice-to-haves?
Exactly. The nice-to-haves take an immediate hit. People get defensive.
Right.
But they still need groceries, right? They still need pharmacy items, haircuts, hardware.
Sure.
Consequently, we are seeing a stark format divergence in the physical real estate. Grocery-anchored neighborhood centers are thriving and they're staying full, while pure discretionary retail is taking on water.
And speaking of the future, there is a massive wild card waiting in the wings, right? The Spokane Aerospace Tech Hub.
Oh, yeah.
They landed $70 million in federal funding back in January 2026 for an advanced composites consortium near the airport. That isn't just a shiny headline. I mean, that's the kind of catalyst for high-wage job creation that could eventually unfreeze this job-hugging mentality and get people spending freely again.
Exactly. It's a medium-term driver that could inject serious vitality back into the local discretionary market, something we are definitely keeping an eye on.
Okay, so let's connect that cautious consumer behavior directly to the actual buildings, which brings us to the story of that 5.3% vacancy rate. You mentioned earlier that we shouldn't just look at the headline number and assume the worst.
We absolutely shouldn't. If I tell you Spokane has a 5.3% retail vacancy rate, while the national average is 4.4%, your immediate instinct is that the market is fundamentally underperforming.
Right, it sounds bad.
It does. But the report explicitly labels this an idiosyncratic drag.
Okay, pause. Explain idiosyncratic drag to me like, I don't read commercial real estate reports for fun on the weekends.
Fair enough. It means the high vacancy isn't because 1,000 small businesses are closing their doors. It's not a systemic market-wide failure of demand.
Yeah.
It's the mathematical result of a few massive, highly specific events artificially inflating the total vacancy number. In this case, it is the ghost of the 2025 national retail closure wave.
The big bankruptcies, Rite Aid, JOANN, Big Lots.
Yep.
These national chains slashed their footprints to survive, and that left some gaping holes in the local landscape.
That's a huge part of it, yeah. But the most staggering single example is that former Burlington store. It was a 146,000 square foot box.
Just massive.
Right, and when the retailer downsized, that massive building sat completely empty and it was eventually converted into self-storage.
146,000 square feet of self-storage. I can't even fathom how many unused jet skis, old couches, and boxes of college textbooks it takes to fill that kind of space.
It's an ocean of stuff.
Right. But it perfectly highlights your point. If one massively oversized building goes dark, it drags the entire city's vacancy average up, even if the neighborhood strip mall down the street is 100% full.
That is the core of the idiosyncratic drag. And this is why context is king for investors. While these massive boxes sit empty, the supply of new retail space is practically non-existent. Like we mentioned, only 49,000 square feet is under construction.
Barely anything.
Exactly. So landlords of smaller, functional spaces aren't competing with a flood of new inventory.
And almost half of that tiny 49,000 square feet is already pre-leased. Like the new grocer planned for the Opportunity Shopping Center in Spokane Valley.
Right.
So here's my question. If supply is essentially frozen at a third of its historical average, shouldn't that 5.3% vacancy rate be plummeting? Why are these 2025 big box ghost towns still haunting these shopping centers?
Because of the harsh physical realities of commercial architecture.
What do you mean?
Well, you can't just take a 40,000 square foot former Big Lots and instantly rent it to a local coffee shop or a boutique fitness studio. The average retail lease size right now is dropping. Nationally, it's actually fallen below 3,500 square feet.
Oh, wow.
Yeah, modern tenants want small, highly efficient footprints.
Oh, I see. So trying to lease out one of those obsolete big boxes is like trying to turn a high school gymnasium into a dozen boutique pop-up shops.
Exactly.
The walls are wrong, the plumbing is all clumped in one corner, and the HVAC system is designed to heat a cavern, not a small bakery.
That is a brilliant analogy. The capital expenditure, the sheer out-of-pocket cost of subdividing those massive spaces, adding individual bathrooms, demising walls, separating utilities, it's enormous.
I can imagine.
And in a high-interest rate environment, landlords are incredibly hesitant to take on that kind of debt. So the big boxes sit empty, artificially inflating the overall vacancy rate, while the smaller, ready-to-go spaces remain highly competitive.
So it'll take a while to clear up.
Yeah, CoStar models actually project vacancy will eventually ease as those awkward spaces are finally absorbed or repurposed, simply because there's almost zero new construction to compete with them.
And that explains the format divergence we discussed earlier. The grocery-anchored neighborhood centers are doing great. But oddly enough, downtown mall rents actually rose 2.1% on firmer leasing activity, while the suburban malls just continued to bleed. It's a flight to quality and guaranteed foot traffic.
Exactly. If you are a tenant signing a lease today, you want to be where the consistent foot traffic already is. This means being anchored by a grocery store or locating in a revitalized downtown core. You don't want to gamble on a struggling suburban mall.
Right. Nobody wants to be on an empty island.
No.
So if the spaces are tight, the big boxes are structurally awkward, and the consumer's defensively hugging their job, who is actually writing checks to buy commercial real estate right now?
Good question.
Let's dig into the transactions over the trailing 12 months and see where the smart money went.
The overwhelming theme here is that the smart money is local and it is highly selective. So the trailing 12-month sales volume is $107.3 million. That might sound like a big number, but the 5-year average is $163 million.
So volume is way down.
Way down. But here's the kicker. 92% of that activity is driven by private, local buyers.
So institutional money from Wall Street or big out-of-state equity funds has basically packed up and gone home.
They're sitting on the sidelines, yeah.
Okay, so let's look at what the local money is actually buying. In January 2026, the Town and Country Center changed hands. This was an $11 million deal for a 3-property retail portfolio totaling over 40,000 square feet. It traded for roughly $270 per square foot, and it penciled out to a 7.33% cap rate based on existing net operating income, or NOI.
Let's pause there because those metrics tell a really profound story for anyone looking to invest. NOI is simply the annual income a property generates after you subtract all the operating expenses.
Right, the actual cash flow.
Exactly. And the cap rate, or capitalization rate, is the return you would get if you bought the property entirely in cash. So a 7.33% cap rate is a solid, steady yield. And what anchored the center? A grocery store and a convenience store.
It's the sturdy minivan of real estate investments.
Yes.
I mean, it is not flashy, it won't win any design awards, but it's incredibly safe. It perfectly matches that consumer shift toward essential spending we talked about earlier.
Yeah, and then you have to contrast that conservative strategy with a totally different investment approach we saw in the smaller triple net deals.
Okay, I love these because the numbers look wild on paper.
They really do.
So in April 2026, a Dollar General in 9 Mile Falls sold for $2.9 million, which works out to $322 a square foot.
Okay.
And then, back in September 2025, a property at 90250 North Newport Highway sold for $3.7 million. That one traded at a jaw-dropping $1,300 per square foot, with a really low actual cap rate of 4.6%.
Yeah.
There was also a ground lease on East Francis Avenue that sold for $2.7 million at a 5.3% cap rate. Let's break down the mechanics here for the listener. What exactly is a triple net, or NNN, lease?
Okay, so in a triple net lease, the tenant, not the landlord, is responsible for the three nets: property taxes, building insurance, and maintenance.
So practically everything.
Everything. If the roof leaks, the tenant pays to fix it. If property taxes spike, the tenant covers the difference. For an investor, it is almost entirely passive income. It's as close to a mailbox money bond as you can get in physical real estate.
So it's basically a financial self-driving car.
Pretty much.
You buy the building, you hand the keys to a corporate tenant like Dollar General, and just check your mailbox for a check every month.
Right.
But explain that cap rate dynamic to me. Why would an investor happily pay $1,300 a square foot for a low 4.6% return on the Newport Highway property when the buyer of the $11 million grocery center got a much higher 7.33% return?
It all comes down to the price of risk. A lower cap rate means you are paying a premium price for extreme safety. A 4.6% return might seem low, but if it is backed by an ironclad corporate guarantee from a massive national brand on a 15-year triple net lease, the risk of default is incredibly small.
That makes sense.
Right, but the buyer getting 7.33% at the grocery center is taking on more management risk, more leasing risk if a small tenant leaves, and, more maintenance responsibility.
So we're seeing a totally bipolar market here. On one hand, you have the $11 million grocery center buyer wanting stable community staples. On the other, the NNN buyer is paying top dollar just to avoid dealing with clogged toilets and roof repairs.
That's the trade-off.
What does this tell us about what local buyers actually value right now? Is it just a massive flight to safety? You are prioritizing certainty over aggressive growth because you want in-place income that is insulated from economic turbulence.
That is exactly what it is. Risk mitigation is the absolute name of the game right now.
And that hunger for certainty is fundamentally tied to the cost of money, which brings us to the capital markets snapshot and what to watch in Q3. Let's look at what is actually happening with debt.
This is where the ice is finally starting to crack.
Really?
Yeah, the credit environment is quietly thawing. I mean, we have lived in this punishing higher for longer interest rate regime for what feels like an eternity. But CoStar notes that banks are finally starting to ease back into commercial real estate lending.
There is a specific metric in the report that really jumped out to me. The government to corporate bond spread has narrowed to roughly 1 point.
Right.
Now, just to translate that from Wall Street jargon into plain English for a second, investors usually buy government bonds because they are virtually risk-free, but they pay less. Corporate bonds pay a higher yield, but they are riskier.
Exactly.
When the difference in payout between the two narrows down to just 1 point, it means investors no longer view corporate debt as super risky. They're willing to accept less of a premium to lend to businesses.
That is an excellent breakdown. Historically, when that spread narrows, it acts as a massive green light. It signals that institutional confidence is returning, which is a major precursor to firmer investment activity.
So the banks are loosening up.
Yes, lenders feel safer injecting capital into businesses and, crucially, into commercial real estate.
So the money is slowly becoming available again, but we still only saw $107 million in actual transactions. With the average market cap rate sitting at 7.4%, the report argues that the binding constraint on deal volume isn't really debt availability anymore. The money is there if you want it. The real issue is the bid-ask gap.
Yes. This is the high-stakes stare-down happening in every broker's office right now.
The staring contest.
The staring contest. The bid-ask gap is simply the difference between what a seller demands and what a buyer is willing to pay. Sellers are anchored to the past. They remember the peak pricing of 2024, and they want that number.
Right. It's like trying to sell a used car based on what you paid for it 3 years ago, completely ignoring the 50,000 miles you put on it.
Perfect analogy.
But the buyers are looking at today's reality. They're looking at their 7% debt costs and saying, the math literally does not work unless you drop the price. So what does this all mean? The money is there, but nobody wants to be the first to blink. Who usually wins this standoff?
Well, if we connect this to the bigger picture, time is the ultimate equalizer. Often, sellers will hold out until a loan matures and they have to refinance at a higher rate, or maybe a life event forces the sale.
Right.
But currently, buyers focused on moderate pricing and in-place income hold all the cards. Because there isn't a frenzy of institutional capital competing for these assets, local private buyers can afford to sit back, sip their coffee, and just be incredibly patient.
But the macro environment might just gently force both sides to compromise eventually.
Oh, so?
Well, the report points out that cap rates are expected to begin drifting lower nationally, starting with multifamily and industrial properties. As those sectors get more expensive, investors will inevitably chase yield back into retail. That might slowly bridge that bid-ask gap and saw out this market from its current steady but measured pace.
It is all connected, yeah. As one sector prices up, the capital naturally flows down the path of least resistance.
Wow, we have covered so much ground today. From the job-hugging consumer stalling the economy to the 146,000 square foot ghost of Burlington inflating the vacancy rate, all the way to local investors buying up essential grocery centers while institutional money hides on the sidelines.
It's a lot to take in. But this raises an important question, though, as we look to the horizon. We touched on this briefly, but the retail demand drivers, the rooftops, the daytime population, the household incomes, they are actually strengthening much faster east of the state line in North Idaho than they are within Spokane proper.
Right, over in CDA.
Exactly. So if remote workers continue this job-hugging trend, but they prioritize living in Kootenai, Coton County for lifestyle reasons, does the center of retail gravity permanently shift eastward?
Oh, wow.
And if it does, will older Spokane retail hubs be forced to completely rethink their entire purpose?
That is a massive demographic shift to ponder. It's the kind of tectonic plate movement that changes an investor's entire map over the next decade.
It really is.
If you are sitting on capital right now, maybe looking at these local private buyers swooping up neighborhood centers, you need to be weighing these geographic shifts heavily before you write a check.
Absolutely. Knowledge is most valuable when you can apply it to the reality on the ground. You have to anticipate where the consumer is going to be in 5 years, not just where they are today.
Such a great point. Well, thank you so much for joining us for this deep dive into the Q2 2026 data. Remember, if you want to explore these Kootenai, County geographic shifts, or dig into the latest triple net comps we discussed, or get a custom market breakdown tailored to your specific portfolio or investment goals, you should reach out to Eric Peterson.
He's the guy to call.
Yeah, he is a broker at ACTIV8, Activate Real Estate, and you can reach him directly at 509-903-9077. Until next time, keep looking past the headline numbers.